This chart breaks down India's total gross domestic product. Notice this massive block dominating the structure. Nearly 60% of the country's entire economic output is driven by one thing: domestic consumption. For years, that consistent compounding household spending has been the primary engine, pushing major stock indices like the Nifty and Bank Nifty into multi-year rallies. You can see this capital deployed daily. Every floor of retail space, every packed storefront, and every transaction represents the raw fuel keeping the broader market elevated. But right now, a specific pressure point is squeezing that exact engine. It is a structural weakness quietly shifting market dynamics while most traders look the other way. Identifying these specific pressure points reveals the exact moment a market correction begins, signaling where institutional capital will move next. The vulnerability starts here. India relies heavily on imported crude oil to maintain its daily operations and keep the domestic supply chain moving. When geopolitical tensions escalate, global energy markets contract. This creates an immediate supply side shock, pushing the cost of imported barrels significantly higher. Those global premiums do not stay at the border. They flow straight down into the local economy through multiple consecutive fuel price hikes at stations exactly like this one. Economists call this imported inflation. A higher price per liter instantly increases transport costs, making manufacturing materials and basic groceries more expensive. The national freight network carries that burden literally. Inflated logistics costs hit distributors and retailers hard, heavily squeezing their operating margins. High energy costs exert a sustained systemic pressure on the economy, steadily eroding the purchasing power of the average household budget. The math for those households is rigid. When paying for transit and basic food takes a larger percentage of a monthly paycheck, the capital normally reserved for extra discretionary spending disappears. The first signs of trouble appear in big ticket items. Consumers become cautious, and heavily financed purchases like new cars are the first to be postponed. Next, the shift moves to everyday goods. Shoppers start aggressively trading down, swapping premium fast moving consumer goods for cheaper alternatives just to manage their daily expenses. Because consumer spending makes up that massive 60% chunk of the economy we saw earlier, a pullback here creates a contagion effect. The damage refuses to stay confined to the retail sector. Watch how this chart maps the slowdown. The drop in baseline retail demand radiates out, quickly hitting consumer durables and cooling off housing demand across major markets. When the everyday consumer stops spending, the broad economic growth narrative fractures. Analysts are forced to step in and slash future earnings expectations. That pullback on Main Street eventually winds up here in the financial hubs, where lower retail spending translates directly into market volatility. As profit margins shrink across the FMCG and auto sectors, any attempt at a broader Nifty rally faces heavy overhead resistance. The earnings simply don't support the valuations, but traders need to pay closest attention to the banking sector. The Bank Nifty is uniquely exposed to this exact type of consumer slowdown. This chart reveals the mechanics of that exposure. When car purchases are deferred and shoppers tighten their belts, banks see a sharp drop in vehicle financing and credit card growth. This shrinking loan book forces bank executives to replace high growth projections with slashed forward looking guidance. Ignoring these underlying credit trends is dangerous. Missing the signals in loan growth is the fastest way to get trapped in a bank nifty correction. However, institutional capital rarely just sits in cash. When wealth is destroyed in vulnerable sectors, that money actively rotates into assets positioned to benefit from the new environment. The primary destination for this fleeing capital is the energy transition. Companies building long term independence from expensive fossil fuels start capturing the market's attention. Interest accelerates aggressively into utility scale renewables. Massive infrastructure projects like this offer a direct hedge against the volatility of imported crude oil. The money also moves away from traditional internal combustion auto stocks, pivoting instead into electric vehicle infrastructure and green manufacturing. This flow diagram shows the sheer velocity of the shift. You can see the volume of smart money abandoning traditional discretionary lanes and heavily expanding into power infrastructure. Elevated crude acts as a catalyst for new sector leadership, rewarding traders who identify the shift into green infrastructure before the broader market reacts. Navigating this environment requires a longer term horizon. This is a multi quarter structural shift unfolding across the economy, not a quick intraday fluctuation. The institutional playbook demands strict tracking, monitor foreign investor flows, retail inflation data, and monthly auto sales reports to gauge the true health of the consumer. As the market digests this rotation, risk management is critical. Pay close attention to technical support and resistance levels and size your positions to survive the volatility. The reality is that market leaders are actively changing right now, driven entirely by global forces extending far beyond local borders. The most profitable market moves don't announce themselves with a headline. They begin with slow structural changes that the retail crowd ignores until the trend has already passed them by.